The KPI is also what makes it so hard. And the KPI is generate exceptional risk-adjusted returns for our limited partners while helping the daring build legendary companies. Like that's the KPI.
Welcome to Partner Path, a podcast that unpacks the venture capital and growth equity ecosystem from a junior perspective. Young entrepreneurs and investors have already had a massive impact on the industry, having started unicorns and launched billion-dollar funds. We discuss these success stories and more by sharing perspectives and advice from some of the industry's most prominent role models. This podcast expresses our views as of the date published and does not represent the views of and is not endorsed by any company for which we work. Before we get to the episode, Laura and I are excited to announce a partnership with Overlap. Fresh out of Y Combinator's summer batch, Overlap is an AI-driven app that uses large language models to curate the best moments from podcast episodes. Imagine having a smart assistant who reads through every podcast transcript, finds the best parts or parts most relevant to your search, and strings them together to form a new, curated stream of content. That is what Overlap does. I personally use Overlap to explore content on future podcast guests and highly recommend it as another diligence tool for investors. Check out Overlap on the App Store today.
Today we are chatting with James Flynn, an investor at Sequoia. James started his career at General Atlantic before joining Sequoia to focus on growth stage investments. James focuses on AI application layer, fintech, consumer, and hard tech. Welcome, James.
Thanks, guys. So excited to be on.
So let's start with your upbringing. Touch on what you were like as a kid and maybe some of those qualities that have persisted to you today as an investor and just who you are as a person.
Yeah, totally. So just as background, I grew up in Toronto, really great family, had the opportunity to go to great schools, play a bunch of sports, had a really nice childhood. I think the two characteristics that probably have stuck with me throughout most of my life are just being super curious and then being really, really competitive. And so those things when I was growing up, I spent tons of time listening to podcasts, reading books, trying to just like understand the world around me. And it manifested through politics, through a whole bunch of different subject matter. So I've always been like super curious. And then on the competitive side, I spent a bunch of time playing sports, have always really hated to lose, whether it's like a very competitive outside of school sport or like lunch basketball. I would go back to class like covered in sweat. Teachers were probably like, what's going on here? But I just have always hated to lose. And I do think that both of those things are probably like still relevant in my job today. You know, we as investors have to be super curious about all these different subjects that we're learning about all the time. And then venture is a really competitive market. And I think that we at Sequoia are sort of pride ourselves on being hyper competitive in some ways, and liking is a characteristic that a lot of people have here. And I think sort of has its origins for me back as a kid playing a bunch of sports, basically.
Definitely. And I do think we have learned that Sequoia loves athletes and they love competitive spirit. And so that brings me to going a little bit deeper down the athlete road. I mean, you played squash and you were a pretty good squash player from what I've heard. I'm not sure if you're better than Will or if Will was better. We can talk about
Definitely
that later.
Better.
Maybe touch on the impact that squash has had on your personal and professional growth. And I think just working in a team and learning how to work with different types of people.
So squash is an interesting thing where it's an individual sport. Maybe not everybody knows squash is a very niche racket sport where you hit a ball against a wall, basically. And so it's a sport that you play on your own. And I think that individual sports in general teach you a whole bunch of things about relying on yourself. You know, like there's nobody else out there with you when things are going wrong. And there's also nowhere else to point when things don't go well. Like you lose, it's like so clearly on you, right? There's nobody that you can blame other than yourself. And so I do think that teaches you a lot of resilience and also like self-reliance. And so I think that's one thing that from squash has been very valuable for me. And then I think sports in general have, you know, this characteristic where in overall, if you work hard at things, you will get better in sports. You know, people have different levels of aptitude. People start in different places. In basketball, some people are 7 feet tall, some people are 5 feet tall. But given where you're starting, almost always when you sort of like train hard, train intentionally, you get better at things. And I think that is like a very important learning that comes from sports and just seeing, hey, listen, I lost that guy last week. Like now I'm beating him because I did these things. That sort of like growth mindset or recognition that work in combined with a bunch of stuff that you can and can't control equals outcome is pretty powerful too from sports. And so those are some things on squash in general. I think working in a team, it's an interesting thing when you get to college. And when I played on the Penn squash team together, you end up going from this sport that's totally individual to all of a sudden, you don't really care if you win or lose your match so much as you care what happens to the team overall. And so when you go through that transition, it's interesting how it ends up mattering more to you, how you play, because it impacts the outcome for your teammates. And I think there's a lot of similarities between that and what we do now, where like everybody has their role to play at an investment firm, but everybody's success is very much a function of what their teammates are doing. And so I think that sort of theme has continued to follow me, and I'm sure a bunch of us that played sports in college, into the working world.
Are there any qualities that you think from whether it's like sports or personal life that have translated to venture that really makes you stand out in the venture world and might be considered your superpower?
Yeah, it's an interesting question. I always find the superpower question hard to answer. I think it probably is just like curiosity, to be honest. Like I do think that I've always been somebody who's like gotten maybe the most satisfaction from feeling like I understand something. And I do think that like investing in general is in some ways, all that matters is your opinion to some extent, right? There's a whole bunch of other stuff going on, but ultimately like investors get paid to have opinions and to understand how systems work and to have a view on sort of like who's going to benefit from that basically and who is well positioned to capture a market or a trend. And I do think that sort of like just getting real satisfaction from understanding things and then hopefully applying it to make good decisions is probably like the quote unquote superpower. But I don't know if it's so super yet. Still working on it.
Fair enough. And you actually went right into growth equity after Penn, which I think is unique. A lot of kids from our school will take one of the more traditional finance routes where they're going to banking or consulting or you're even going to a startup. So I'm curious, what was the initial hook to join GA? And then obviously we'll get into Sequoia and more of your venture experience there.
I'd say, during COVID, I think everybody spent a lot more time with technology in general, whether that was Zoom or it was like, I don't know, seeing how the vaccines progressed and all of a sudden we could go back to our lives because of something that tech had created. And so I sort of like during that period was very interested in understanding like, listen, the thing that really changes how the world works is technology. I want to be part of that. And I think like as somebody who had a finance background, the obvious way to be part of that to some extent was like to do it as an investor. And so that's what I was most interested in. Tactically, maybe on like do the 2 years of banking and then switch into investing versus go straight to investing decision. I basically decided the job that I would want to get after 2 years of banking would be a job at one of these growth or venture firms. Why not try to get that job right out of school if I could? And basically, forego some valuable training, but also just start doing the thing that I knew that I wanted to be doing faster. And so that's kind of why I decided to try to go straight to the buy side, quote unquote. And GA was an incredible place to do that. Like GA has a program for people who come out of school and you get to sort of spend your time talking with entrepreneurs, doing diligence on companies, understanding how one of the best tech investment firms in the world thinks about making those decisions. And so to some extent, it was a no-brainer for me, given that opportunity to kind of jump at it and go with that.
Yeah, that makes sense. And I think GA is a little bit untraditional from most venture firms in the sense of there is more of like a structured program. You have other analysts. They're teaching you skills, which is nice. I mean, you're getting thrown in the fire as with any buy side role, but at least you're learning along the way and hopefully you had mentors and people to guide you.
Yeah, totally. No, they do a very good job of kind of bringing people along and also giving you like a full stack investing role right away to some extent, right? Where you get to be involved in a deal's entire life cycle, right? From the very first email that you send to a founder when they have no idea who you are, all the way to like extending a term sheet. You, even at the earliest stages, get to be part of all of that and see how the whole flow works, which I think is actually like really powerful and a real strength of kind of what they do at GA for people coming straight out of school.
That's amazing experience. What would you say were some of the downsides of going into the buy side right after school, or maybe some of the parts about venture that are less talked about?
The downside of going to the buy side straight after school, I think that like you definitely give up some optionality to some extent in your career. Like everybody in the world, not everybody, but most people in the world know what Goldman Sachs is. A lot of people know what General Atlantic is, but like, orders of magnitude fewer. And so If you're not so sure what you want to do, then I think that sort of staying broad, doing banking, something that is totally respected by like a massive group of people, can be the move. I was sort of lucky that I had conviction that what I wanted to be doing was tech investing. And so I figured that going to the buy side was the right thing for me. And I don't feel like there were too many downsides for me. On venture in general, I don't know if it's like a bad part, but I think like a really hard part of the job is that you almost always know less about the thing you're talking about than the person you're talking to about it. Like the founders that we spend our time with just have spent their entire lives in the categories that they're building and are some of the smartest people in the world. And so you, as generally a generalist, need to like come in and try to have an opinion on that with way less domain information, but then hopefully some useful broad frameworks and useful context from other markets to bring to that kind of like thought process. And that's like pretty hard to do. And I think like early on, for sure, in my first few months at GA, you're straight out of school. You literally know nothing even about like software in general, who are the founders of these companies. It can be a little bit intimidating. And there were definitely moments when I'm sure I sounded really stupid. And so that's maybe one of the hardest parts of it.
Yeah, and that's something I think we'd love to touch on later, is trying to understand how in a room full of experts and people with more wisdom later on in their careers, you can act and actually add value in a certain degree. But I would love to double click on your process of joining Sequoia, given it's a particularly unique one. I mean, obviously you don't need to cover all the details, but as Laura mentioned earlier, we had Romy Boyd on the show before, who's one of your colleagues with the growth focus at Sequoia. And I know she spoke to her dialogue with Pat Grady and her process of joining the team. And so we'd love to hear your story and your dialogue with Sequoia, and just trying to understand what Sequoia looks for in a junior investor to start.
I think, like Romy, my conversation with Sequoia started with a cold email that landed in my inbox. I think it's like a very Sequoia thing that, despite being Sequoia and having had so much success, like they're still so proactive in every part of the business, whether it's hunting for companies or hunting for candidates. And so, during that process, you meet everybody on the team. It was like a really incredible experience, such a great sell, honestly, for Sequoia, just to get to spend time with those people. Like you spend time with the team and you really understand these people are different. I think what Sequoia looks for, the public spec for the growth team, and I think for investors in general, is kind of like hyper competitive and heart of gold. So I suspect that those things were involved. And I think that leads to the question about Sequoia liking athletes. And, there are a lot of athletes on the team. And I think that's the hyper competitive piece. But most people who've worked here have ended up being flagged to somebody on the team as just like really doing a good job in their previous role. So it's funny when you get, cold emails to chat from people in college and people ask about trying to get a job at Sequoia. I think the right advice is often like just to try to really crush whatever you're doing at the time and have just like good buzz about what you're doing, to be honest, and hope that makes it back to somebody at Sequoia. So that's sort of like, I don't know, what they look for and like the process. My process sort of went, you meet everybody on the team. I then had done my last conversation with Rulof, who runs the firm, and I like hadn't really heard from Andrew me through the process in a little while. And so that's generally like not a great sign when you're trying to get a job and you don't hear from the company for a little bit. So I decided to send a big email basically to Pat Grady, who runs the team. And I think like the macro lesson here is, when the worst case scenario of doing something is like the same as the status quo, you should probably do the thing. And like cold emails often fall into this category, where like the worst case scenario of sending a cold email is that the person doesn't reply and the world doesn't change. But sometimes something good happens, so you might as well do it. So here I sent a big email to Pat, basically like trying to make my case for why they should hire me. And I structured it a little bit like a Sequoia investment memo. And I went through the different phases of an investment's life cycle, from like, picking, winning, company building, as though I was the company that they were considering investing in. And, Pat replied in his way saying quickly, just, great email, more to come. And I was a little bit confused about what that meant too, but eventually ended up hearing from Andrew and got the job. And I have no idea if it was because I took the risk to send this like very long email to Pat, but I'm very glad that I did.
Now, a quick word from our sponsor. Laura and I are thrilled to announce a partnership with Grata, an intuitive deal sourcing and diligence platform. Keep missing out on private market deals? Ditch the Rolodex and get Grata. Grata's AI-powered platform provides accurate data, deep insights, and time-saving workflows that help get more deals done. And it's trusted by over 500 firms and 3,000 deal makers, including myself. I've personally used Grata in both my deal sourcing and diligence workflows and would recommend their tool to any investor across private equity, growth equity, corp dev, or investment banking. We've negotiated a special offer for our audience. Mention PartnerPath to the Grata team during signup, and you'll get free executive seats for your partners and MDs included in your subscription. Now, back to the episode.
I'm curious to hear, first of all, it's a very creative idea. And I very much agree with your approach to the world through taking chances and figured what's the worst case scenario and trying to understand almost like the option value there. Did you ever hear from them on how that made you stand out? Because there are certain things you could take out of an email like that, right? It's someone who's bold and we like that. It's someone who's very introspective and we like that. It's someone who's creative. Like, there are a lot of takeaways from something like that. Did you ever understand the quality or multiple qualities were from doing something like that made you stand out to the team?
I think the thing that it's not was the content in the email. Like I sort of restated my case, but brought up facts and points that they had already heard about in the conversations. So I think it's like importantly not the content. What I think might have resonated is sort of that I did it. Like there are people talk here about, you need people and we need to as a team both like go to the gym every day and do the work, but then we also need to like be willing to take the game winning shot. And this was definitely showed at least like a willingness to take that shot. And so I think that was probably an important part of it. And then I do think that probably like, hey, listen, this guy did a good job at the email, did it in a creative way by the way that sort of the email was laid out. I think that all of those things probably resonated as well. But I think more than anything, it was just the willingness to take the shot. And again, listen, I have no idea if this email is why I got the job, but I do think that, that's something that I heard from the team is like, listen, it was really good that you at least did it.
And then I guess the natural follow-up question here is, have you done something similar or thought about doing something similar on the job? Right.
Like not really is the answer.
Yeah.
I think like you always need like a classic move in sourcing is we'll be in the city. Like, do you want to grab lunch? But like, you're not actually going to be in the city. And so you sort of book the flight once you hear back from the person.
Yeah.
And so I've done that a couple of times, like I think that's been successful. I was like, have traveled a little bit for things related to that. And sometimes you do have to like write the really long, thoughtful email and spend more time than you think you should on any given one company. And so that has definitely happened from time to time. And sometimes the unfortunate thing is you spend like 2 hours writing this really great email and then you like still don't hear back from the person who you sent it to. But in general, I think like there's no story that stands out really from my time here so far. But I do think like the nature of venture is that like a handful of companies and investments make a fund, make a career, make, just like make it all worth it. And so you do have to be willing to do sort of like irrationally deep amount of work on those handful of companies to break in, to build a relationship, if you think it has a chance to be one of those special investments. So none come to mind, but in theory, I should do something like that.
Yeah. It takes a while. It's a little bit of a numbers game, or at least can be, at least for junior folks. So you mentioned a little bit about the framework of assessing a company, a founder, potential investment. You had a view on that from the outside in the interview process. Now you've been with Sequoia for a decent amount of time now. I guess you're coming up on a year. What have you learned about the underwriting process from Sequoia's perspective, and how does it contrast to your experience or perspective you saw at General Atlantic?
So GA and Sequoia are both great investment firms that I think have sort of underwriting processes and investment decision-making processes that fit both the kind of return profiles that they're looking for and also the stages at which they invest. So GA is like a very late stage growth investor. And at that late stage, it's mostly about the numbers and the business and the mechanics of it and the paybacks and all the software metrics that we all see in guides all over the internet. So that tends to be kind of how General Atlantic looks at investments. We at Sequoia are earlier stage, and also the mission of Sequoia is to help the daring build legendary companies from idea to IPO and beyond.
Yeah.
And so,
End quote.
Yeah, exactly. And so it ends up being very much about kind of the founder and the vision and an under market in the world is going and why this company makes sense given that, and also will be part of driving us towards that future. And that is a much more qualitative thing. And so we think about building a thesis around a market, a company, a founder, and then using the evidence that we have from the business to date in support of that thesis. But the evidence and the financial information is not the story in and of itself. And we will never make an investment in a company just because of the numbers. The numbers are support of a thesis that is based on those qualitative factors that I described, versus I think at later stage investment firms, the numbers are the thesis, at least more so, because when a company has hundreds of millions of revenue, you like kind of believe that the team is probably good if the numbers are good. You kind of believe the market probably works if the numbers are good. And you also need to believe in less future distance traveled. Maybe you need the company to grow 5 times to make 3 times your money because you're going to have some multiple, contraction. Versus we often need to, or at least hope, that the company grows 1,000 times. And the answer for why a company grows 1,000 times is never going to be in the numbers to date. It's always going to be in the team and the market changing. And so we spend way more time thinking of that than we do digging into every possible version of the customer file cut. We definitely do all of the same work that was done at GA. It's just always support of the story. The numbers, they're not the story themselves.
Yeah. And obviously Sequoia has a strong early stage practice. You personally have a growth focus, right? And so I'm sure if you were to slap a coefficient to the importance of founder and market and business model relative to maybe other folks on the team that have an earlier stage focus, you probably focus a little bit more on the business model. So maybe you're on the journey from GA lens to more of an early stage lens and somewhere in the middle. If you try to think through how you think about, I'm using, for lack of a better term, those coefficients, if you're to say founder, management team, market, and then the company and business model, and how they shift over the stage a company is at, how have you thought about the relative importance of business model compared to those other two, which are probably the majority of the percentage at the earlier stages when you evaluate investment at the growth stage?
The answer is that it varies company to company so much. And so it's hard to assign precise weightings on things. I would say that business model, to the extent that it comes through in the numbers, is probably a little bit less than half of our decision-making process. And then founder and market, probably more than half of what we're thinking about. I think it's interesting because even at the latest stages, that continues to sort of be true, right? A bunch of people, I'm sure, buy NVIDIA stock because they're like, Jensen is a badass and he's just going to keep winning.
Yeah, the leather jacket effect.
And he's got great style. I think founder and that's obviously a great market, continue to be important all the way throughout a company's journey. I think for us, like I said, the business model and the characteristics of that, to the extent that they show up in the financials and the customer data, is very much supporting the thesis around the founder and the market. Exceptional, then that often disproves a founder thesis or a market thesis, right? And you have to think about the reasons why those might change over time, and the reasons why it makes sense to do this in a certain way in the short term that maybe makes the gross margin less pretty, but sort of that benefits you in the long term. But overall, you definitely need those things to all check out. But I think that we probably spend more of our time thinking about the qualitative parts of a company than we do about kind of the quantitative financials of it.
And if you were to throw those 3 factors on a binary scale, right, you either have it or you don't, which one would you say is the most important to have and which is the least important at the growth stage?
I still think probably the founder is the most important, just because of what I said about, the distance that needs to be traveled. Even at the growth stage, I've worked on investments in companies with literally 0 revenue and investments in companies with more than 100 million of revenue. Both of those companies, we hope, get to many billions of revenue, and the path from where they are now to the future is just the founder. That's such a big part of it. So that's probably the most important binary factor.
I think it would be also helpful to unwrap the layers of being someone newer in your career at Sequoia. What does that look like? Who are you working with? what are the metrics, or I don't want to say KPIs, but what does your job look like? And what would you say has been the most difficult aspect, just like getting up to speed at such a notable fund?
The KPI is also what makes it so hard. And the KPI is generate exceptional risk-adjusted returns for our limited partners while helping the daring build legendary companies. Like that's the KPI. I think one of the unique things about Sequoia is that that's the KPI for everybody at the firm. It's like a fairly small group of people. There are, I don't know, less than 30 investors at Sequoia. And so because of that, you can't really afford to have the specialization either by sector, we're all in general generalists, or by function that you can have when you have a firm with hundreds of investment professionals. And so everybody's trying to do those two things. At Sequoia, our value chain is founder first, LP second, Sequoia third, individual fourth. And everybody that and the KPIs are kind of the same for everybody at the firm. So that's kind of hard in a lot of ways because there's a bit of a, okay, like where do I start? What do I do type of problem. And so I think early on, it's really just about doing a couple of things. One, taking risks, getting out there, talking to founders, going to events, just trying to like be in the ecosystem as much as you can. And it's definitely true that being at a place like Sequoia gives you an unfair advantage in doing that because of this platform that's been built by a lot of people who were doing it before any of us were born. And I'm super thankful to get the benefits of that. And then the other piece of it is just to try to absorb as much of that tribal wisdom as you can. When I first joined, I spent a week shadowing Andrew. I spent a week shadowing Sonia. I spent a week shadowing Ravi. I spent a week shadowing David and Pat. Like you just need to really spend time with the people who are the best in the world at this and understand how they do the job. And so those are probably like the two ways to help get up to speed. But ultimately, we're all still figuring out how to do those overarching goals of helping the daring build legendary companies and generating exceptional risk-adjusted returns for our limited partners. I think it's actually an interesting thing. Like, Sequoia is a place where there's a lot of phrases that are repeated, and if the place didn't like live those values and those phrases so fully, it would seem like kind of nonsense propaganda. And definitely, like, I can understand why it may seem like that from the outside, but the reality is like it's actually legit. And so even internally, you end up being like just sort of consumed by those goals and consumed by the way Sequoia thinks about them so much because everybody else is, and because they're actually like worthy goals. And so it's pretty legit.
I mean, that's fair enough. I also think you can hear founders speak for themselves. When they speak about Sequoia and what they're telling others, I think it resembles what you're telling us today. And that's always the best check that we say. When people are debating working with us, we just say, hey, call our founders. They'll tell you the truth. They'll give you straight up what we're like to work with. I mean, if we do embody the values that we're sharing with you verbally.
Totally. No, that is the ultimate test always.
Maybe if you could just touch on what percent of your job is like sourcing, diligence, and then you've worked with some pretty successful companies such as Clay, and touch on how you're adding value at the portfolio level.
On sourcing and diligence, it varies so much week to week. I think roughly it's probably close to 50-50 in terms of meeting companies pretty close to the top of the funnel to like doing real execution work on companies when we're in the heat of an investment decision. And both of those parts of the job are super interesting, and they obviously like flow together to some extent. When you're doing diligence, you're blind unless you've talked to the other companies that are playing in the category. And when you're sourcing, you're blind unless you've actually gone deep on a company in that space and understand what things look like when you unpack it and have gone actually really deep on the market. So those two things I think are symbiotic in a way that's not always talked about, but it's close to 50-50 on those things. And then on the portfolio level, in general, as a junior person, you have to like out hustle or at least like be willing to really hustle to make an impact on portfolio companies when you're working with them in a way that, you probably have to do, or at least when you've been doing this job for 20 years, you have more ability to say, when I was on the board of this company, we did this, and that applies to your current situation in this way. As a junior person, I think it's really about like a couple things. One, like doing the work on the numbers and being very truth-telling on reflecting back to the company what we see when we look at their business, because companies don't always look at their businesses in the same way that investors do. And that's like overall a really good thing. But sometimes there are things that investors do and analyses that we conduct that's often a junior person thing that's really valuable when you show it back to a company. And so I remember a way that junior people in venture can add value is that there's sort of this like junior person in venture whisper network that exists where like people are always talking about companies. People are
You
always
mean
like,
the rumor mill?
yeah, the rumor mill. Like people are sharing numbers. Sometimes we get these like WhatsApp messages that are like 50 lines long with like bullets on a whole bunch of different companies. And you're like, who typed this up on their phone? But it's great. Please keep sending them. And so I do think that like having that finger on your pulse of what's going on in the competitive landscape can often be pretty helpful, and you can understand where the heat is to some extent, what new companies are popping up in the category, how people are doing, in a way that like companies are, customer aware or customer obsessed, but competitor just aware. And I think that we spend more time thinking about the broader competitive landscape, or at least hear more things randomly about the competitive landscape. And so surfacing those things up to companies is often valuable and like a uniquely more junior person in venture thing. Because once you're like very senior, my sense is that you just like, there's less of this chattering that goes on just because maybe you're more mature and know that it's like a dangerous thing to do, or maybe because it's more direct with the folks at other firms a little bit because you guys are like going up against each other as like really leading those deals. So just kind of surfacing what we hear from this big rumor mill that exists in the venture industry is also a way to be helpful.
How does Sequoia think about investing in competitive companies? And by that, I mean, like you said, it's a very flat organization. You have at least 30 investors. And so partners may have opinions on different companies on who they think might be the winner in that category. And if everyone's a generalist, then deploying capital can go into similar spaces. How does your team think about that?
We never want to invest in two companies that do the exact same thing. That I think is true for probably every venture firm in the world. The nature of early stage investing is that companies don't always end up doing exactly what you thought they would be doing when you invested in them, and people weave and change over time. So I think we understand there's always the risk that companies end up competing in some way. Hopefully, again, it's not like perfect overlap, but there's always a risk there's going to be some overlap. And so that's kind of just, we view it as the nature of the business to some extent. And there are a whole bunch of systems that we have internally and ways the information is firewalled. During portfolio review, where we talk about the whole portfolio, sometimes people get up and leave the room if they're on the board of a company that is maybe in the same universe as a business that's being discussed. Instacart and DoorDash is probably like a classic example of this, with two scaled companies that Sequoia worked with, where those two companies didn't do the exact same thing to start, but over time, the sort of food delivery and in general delivery market, became very competitive, and everybody tried to do all sorts of things in a bunch of different item categories. And so now they're just systems. We still are investors in both of those companies, and there's a way that we make it work so that information is sort of only available to people who it should be. And we can be great partners to both of those companies at the same time. So the answer is basically, ideally, we don't invest in companies that are completely overlapping. Sometimes overlap does happen. And when it does, we just try to make sure we're doing the right things for both of those companies by keeping any competitive dynamics that might exist, like, very walled off.
One question that's a different take on competition and more towards the valuation side of things I'd be curious to get your thought on is, you mentioned a couple of times you're helping the daring build these incredible businesses, and you're less oriented around maybe valuation, especially at the early stages. And I think there are a handful of investors who take a similar approach, right? It's a binary. We need to be in this company. And as a result, we're okay to a certain extent paying whatever. I'm curious to explore to a certain extent and understand, have you seen businesses that have priced in too much opportunity, too much growth? Maybe the founder is so good that it actually doesn't make sense to make an investment at that valuation. And I guess the reason I say that is because we're going to move into the AI application layer and then the infrastructure layer, where there's some incredibly competitive rounds where you're seeing billion, 2 billion plus on either pre-revenue or extremely early days. Have you guys intellectually explored what is too severe of a valuation gap?
Yeah, for sure. At the growth stage, you have to. Because the thing that matters most, to be honest, and the analysis that we've done, and I think a bunch of people have done, like, revenue multiple, you can pay crazy multiples of revenue for really early stage companies. What matters most is like really absolute valuation, right? There are just only so many $200 billion. So if you're trying to generate a 10x return and you're investing at a $20 billion valuation, you need to be like really sure that this company is going to be like one of literally the best. I don't know how many $200 billion companies there are, but like probably not more than 100. I would be surprised companies in the world. And so that's just like a different level of conviction that you have to have. And so 100% valuation matters. I think this is the hardest part of the job, is understanding like where do we lean forward on valuation and where do we sort of draw the line and say, listen, this is just too much. I'm not going to name any specific companies that I think are overvalued.
Totally fine.
Thing to do, but I do think this is one of the things that we think about a lot, and I think it's more so from like an absolute valuation perspective than a multiple perspective, which is interesting. And you don't need to think about it as much at the earliest stages, because if you're investing at 150 posts or 175 posts, maybe that doesn't matter too much. If it works, you're going to be really, really happy. And if it doesn't, then you're going to be sad. And that's just a little bit binary. At the growth stage, you definitely have to be valuation concerned. And we often do get our way to like think our way through to paying prices that feel like we're paying 2, 3, 4 years ahead, quote unquote, of what the public markets would value the company at today. But you just have to have conviction that, listen, if this company is going to keep compounding at 40% for the next 10 years, then 2 to 3 years ahead is not something that is really that concerning. And ultimately, when you catch up to the valuation that feels perfectly in line with the comps, you're going to still have 7 or 8 years of compounding at 40% ahead of you. And that's really, really attractive, right? And at that point, you're sort of in a place where you don't have any more multiple contraction. And so you just, in theory, returns keep compounding at the 40% that the business is growing for those years 3 through 10. And so you can feel really good about that. And so that, I think, is kind of the lens through which we view these later stage investments that we make in really, really high quality companies, where you're still paying ahead for sure of what the public markets would think right now. But you have a lot of belief that this is a business that just has all these super amazing characteristics and will keep compounding for the long term, right? I think like, I don't know, there are a whole bunch of companies in the late stage of Sequoia's portfolio that look like that. And I think we feel really great about those investments, even if, you know, you dropped them into the comp set right now, it would still seem kind of expensive.
I do want to be conscious of time. Maybe we just jump into understanding a little bit more about where you're interested in exploring new companies and new founders. Hopefully 1 or 2 will come to you after listening to this and hearing your insightful view on valuation and judging people. So talk to us about the AI application layer, where I understand you're spending time. Maybe before we get into specific examples, what's your view? What's Sequoia's view on the macro view? And do you think it's helpful to draw similarities to either cloud, the prior software application proliferation, or the mobile development? What's your personal and team view on the overall backdrop?
I'd say in general, there isn't like a house view on these things. And I'm speaking for myself, not for Sequoia. I think everybody has slightly different opinions. And I think that's really great and healthy. My view is that we're basically starting to see the dream come true over the past year or so, call it. You know, I think like I would define the dream as AI can do a lot of the work that people find to be repetitive, they don't find to be particularly creative. And it's not the stuff that makes them get out of bed in the morning and be really excited to go do their jobs. And I think that AI now is actually like being deployed across a whole bunch of different categories, whether it's healthcare or legal or go to market teams or coding, and like doing a lot of that work that people weren't that excited about and doing tasks end to end for them. I think that that's probably the biggest change over the past 6 months, is these like full on agentic workflows that the models can take on for people. And that is really transformative when you think about how we engage with software, because over the past 10 years, software has been a thing that's allowed humans to be more productive, but ultimately humans are still taking most actions, versus now, like, you can entire chunks of work to these models in a way that just lets people not even need to think about it. And just from like a cognitive load standpoint, like, I know that when I was at General Atlantic, we had interns in the summer, and it's like so much better to just know, like, hey, listen, I'm setting this off to the side. Somebody else is going to deal with it, and I can like focus on the things about my job that I really like and are super high leverage and are super creative. And I think that we're getting there with the models. And so I think like me and most people here are like very bullish on this generation of agentic stuff that we're seeing happening in AI, and I think it's like going to be probably more transformative past technology shifts, just because the like fundamental point of doing things autonomously is like really qualitatively different than just doing things better or a little bit more efficiently.
What are the implications on education as you think about the impact that this will have? Obviously, if you draw a similarity to, or you make the analogy to the Industrial Revolution, there aren't blacksmiths or people building railroads anymore. I guess I'm curious to hear your thoughts. If there are agents that are handling full tasks that historically were handled by humans, what are the implications to the importance of education and the cadence at which people need to learn new skills?
I think this is like a really important question. It's not one that actually impacts our day-to-day jobs, but it's one that I think we all think about because we live so close to this AI wave. I'd say like on education, the one implication is that I think that all educational assessments and all educational learning should be basically like open model, right? Like I think that people should get to bring these models with them into test taking environments and collaborate with them throughout their educational journey, because like that's how the real world is going to work. And so I think that like the worst thing that the education system could do is basically like totally shut this stuff out and say no AI in the classroom, because like then you're just leaving people totally unprepared for what the world is actually going to look like. I'm pretty bullish on us finding productive uses of all of our times. Like in the 1800s, I think like, 80% of people worked in agriculture. Now that's like 2%, and we're okay, right? Like we found jobs to do.
Yeah.
I still think we're going to keep finding jobs to do. I don't totally buy the like, we're all going to just be like sitting on the beach, like drinking and letting the models do all the work for us. That seems unlikely to me, partially just because I think people like want to be productive and want to sort of like do things that give them meaning and also feel like are impacting the world. So I think we'll like continue to find things for people to do. I'm not super worried about that. But I do think that it's going to change, just swing back to more generalist kinds of jobs and kinds of education being really important, because like creativity and critical thinking and decision making will be the things that are most important, not just kind of gathering of information or synthesizing of that information or knowing the information in your head, right? Because it's all available at our fingertips in a way that goes beyond even what it is with just Google, because you just like get the answer. You don't have to go find the answer. And so I think that like I'm pretty excited about what it means for how the labor market works and how we all get to spend our time. And my biggest point would just be, I think it would be really, really, really dumb for schools to wall off AI, because I think like you should prepare people for the way the world is going to work when they have to go into the workforce. And I think AI is going to be a really important part of that.
Do you want to jump to a fire round here?
4 quick questions.
Let's do it.
What's one non-portfolio company that you're excited about?
Yeah, I don't have a specific company. I'd say one non-portfolio theme that I'm excited about is like stablecoin powered consumer finance applications. We invested in Bridge that just I think that Bridge is doing amazing things at the infrastructure layer. I think there are going to be a whole bunch of companies that use stablecoins at the consumer app layer, specifically for sending money across borders at like a much lower fee rate than has historically been possible. And I'm like super, super excited about that, because I think that the charges on remittances and sending money across borders is like one of the most regressive taxes in the world, basically.
And what's the best way to blow off steam?
I think it's still sports, like squash, basketball, skiing, whatever. It's like you can't think about anything else when you're playing sports, and that's really great, honestly.
What's one thing you've changed your mind on?
I think just like the power of teams. Growing up playing individual sports, you think like, it's all on you. I think it's really powerful when you realize like it shouldn't be all on you, and it also doesn't have to be. And so I think here, like we lean on each other all the time, and it's super powerful. And I probably didn't appreciate how important that would be.
What's a piece of advice you'd have for a junior in college interested in venture?
spend time with people who are actually going to build and work at companies, not just invest in them. Like I know, at least at Wharton, there were a lot of people who wanted to invest in startups. There were like not that many people that I interacted with on a daily basis that wanted to start startups. And at the end of about people who are building the companies, not about the people who are investing in them. And so trying to meet people who are building the companies and want to work at the companies is like really, really important. And I think probably underrated.
Great. Well, James, thanks so much for jumping on. It's great to see you, man, and excited to keep the dialogue going.
Yeah, thanks for having me, guys.